Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, May 13th, 2016. This week we saw some pretty heavy selling in stocks with bearish candles, plenty of those. We look at market breadths, which did get worse this week. We look at a bunch of offensive and defensive sectors as they diverge. The equities are weak globally, and we look at bonds which are at or near all-time highs. The dollar is continuing its rally off the support, but it's now at first resistance. And of course, if the dollar continues to rally, this will certainly weigh on various commodities. All right, this is S&P 500 ETF SPY on the daily time frame. So first of all, this ETF has dividends added. This price has dividends added back into it. Therefore, with dividends, it did hit an all-time high. Without the dividend, price is actually below the all-time highs. But the important takeaway from this chart is this week finally the bears were took a pretty significant step with a close below the 50-day moving average. And this is the first time this happens since basically February. We closed above it and closed below it, but continued. It was a pretty strong rally, but this is a significant step because many investors, especially longer-term ones, they simply look at the 50-day moving average, and the price is above it, they'll buy it. If the price is below it, they'll sell it. So that's one of the reasons why this is important this week. Also, up here we had, this is actually a couple weeks ago, we had significant selling, so it's possible that this was already a selling climax. It's not exactly the size of candles that we saw here, but nevertheless, maybe already smart money is moving into cash positions or simply locking in the profits from this pretty strong rally. Down below, similar things. I pointed out this divergence several weeks ago. This is a breadth momentum oscillator. It made a lower low while the price of the index made a higher low. So this was a bearish divergence, and it is now playing out. We can see that the price is now correcting. How far this correction will take us, we'll try to find out later on in the presentation. Important down here, we see no breakout in unbalanced volume. We did break out in advanced decline line, so that's a good first step for the bulls. But advanced decline volume line did not break out, so you can see it is still lacking. This is S&P 500 itself without the dividends on a weekly time frame. This is going back about 3 years. So in February we put in a 2-year low, not on closing basis, but nevertheless this is important. And then we rallied from that point into April. If this indeed was the high for the move, then we can put on Fibonacci retracements from here to here, and if the Fibonacci retracements work out, where can we expect a correction to? And of course, the first level to watch would be at 1994, which is a 38.2% retracement. There we could expect, if we continue down, we can expect some sort of a pause or potentially a bounce from here. Of course, all scenarios are possible. There is also a possibility where we just simply turn around and make an all-time high, and the bearish case basically dies. But as of the point today, we see a downtrend in S&P 500 if we zoom out far enough. And this is an all-time high was put in 2015, and since then we were unable to make a higher high. We were able to make lower lows and lower highs, and this is a definition of a downtrend. So based on this fact, we can just say that this is a bearish chart on the weekly time frame, and we will, me personally, I'm looking only to short, and of course my subscribers as well. Now, again, so this is a good level to watch, 1994. Maybe we'll hit it on intraday basis, like with a spike of some sort, and maybe we'll rally. Alternative scenario, of course, we can just simply continue collapse further and just completely fall out of bed and break this low, and this would be very, very bad for the stock market. Regular viewers and visitors to my website at MasterChartsTrading.com have seen this chart in the past, but briefly I'll go over it. This is a daily chart going back to 1997 with the actual price removed, and I left in place the 50 and 200-day moving average. Here in the upper part here we have what's called market breadth index. That's my proprietary indicator which I created. It is used, I usually use it to tell if the stock market, namely the United States stock market, is in a downtrend or an uptrend. And you can see that it called the downtrend here in 2001, the uptrend beginning of uptrend here in 2003, beginning of downtrend 2008, and then beginning of uptrend 2009. As of right now, as of 2015, mid-year, I am considering the stock market in the United States to be in a downtrend, and it is yet to improve significantly, whereas this line needs to get up to above this blue line, and then I would say, okay, now we are in an uptrend. So far we are at 3, and then we have quite a bit of work to do still. In fact, what happened this week, we had a deterioration in the actual readings that go into the determination of this long-term uptrend or downtrend, the raw MBI. The raw MBI actually dropped this week, and now it is at 66.67. It used to be at above 70 here. So that is a deterioration in market breadth readings, and it does make sense because we saw lower prices manifest themselves. So as of right now, again, I'm considering the stock market to be in a downtrend for multiple reasons. This is one of them, and then I'll present more as we go along. This is New York Stock Exchange Composite, NYSE Composite Index right here, and it goes about a year and a half back. Similar indicator here, it's a Breadth Momentum Oscillator. I showed that we had divergences here, and the same thing here. We had divergences. We had a bearish divergence in an indicator, and the price itself made a higher high, but then it moved lower. So the same thing, we see a close below the 50-day moving average. So that's, again, the first time since end of February that the price was able to close below the 50-day moving average. The important thing down here is this index, the New York Stock Exchange Composite, new highs less new lows divided by total active symbols, was able to pierce the minus 10% line here back in actually August, July of 2015, and since then it was not able to get above plus 10. We're getting kind of close. We're at 0.6, 0.7 here, but we're not able to close above plus 10. So in other words, well, it does make sense since we're in a downtrend. There is not as many new highs being made as there are new lows being made. So the new lows outnumber the new highs, and that does make sense. Again, it's the same thing down below here. We're not able to break out in unbalanced volume or the advanced decline volume. We were able to break out in the advanced decline issues. Down below here we have several of the breadth indicators. In fact, this week on Friday we were able to close below 39 here, below 40 here on the percentage of stocks above the 20-day exponential moving average, and you could use this. This could be like a nice system for you. Let's say if the percentage of stocks above the 200-day moving average moves below 20, like for example right here in November, it is already a nice signal for you. You can just short it. So it looks like we are, getting there. A rebound is entirely possible. We're going back and forth before we ultimately collapsed. But the gist of the matter is this is a downtrend. It makes more sense for me to be looking for shorting opportunities versus looking for to go long. Now this could all change if we turn around and make a significantly higher high. All right, let's kind of briefly go over the various sectors and major indices also. Down, this is QQQ, the Nasdaq 100 ETF. Now, this one is somewhat pretty significantly weaker than this S&P 500 itself, because this actually also has dividends in it, and it didn't even come close to the all-time highs, which were actually back here. S&P 500 exceeded them, the QQQ did not. So that already was like a red flag, because technology, it's a very high percentage of the S&P 500, and it is, usually it leads, and in this case it was lagging. And when it rolled over here in April of this year, with a big gap right here that has not yet been filled, by the way, it rolled over and continued lower, closed below the 50-day. So as I just showed, the S&P 500 closed just on Friday. It closed below the 50-day, and in this case, QQQ actually closed below the 50-day still already in April, and you can see it kind of closed below it, came up, and was rejected the 50-day. So now we continued lower. This does not look like a bullish candle, by the way. This looks like maybe like a shooting star candlestick. Anyways, so that's not a very bullish looking chart either. And of course, one of the main culprits is Apple. It's almost 13% of the QQQ. So let's look at Apple next. This is Apple on daily time frame. Now this has been in a downtrend for a longer period of time. You can see the 50-day is well below the 200-day. It didn't even come close here. It did pop above the 200-day, but was pretty much viciously sold here. And then this is earnings gap. Another reason why I don't like to trade individual stocks is because of that, because you have no idea where this will go. In this case, it really went down. And this is multi-year lows, also 52 and multi-year lows, obviously. So, not a pretty looking chart. We could bounce a little bit, but the bias is clearly bearish here, and I would not even be considering going long this chart at all. Volume is clearly confirming this downtrend, making lower lows. This is a lower low in unbalanced volume, and look at those big red candles, red sticks on the selling days, very high selling pressure. This is XLK, so let's go over some of the sectors. This is XLK, technology sector. This one did manage to make an all-time high, and actually this is one of the few sectors that did. This is quite. If you are trading this sector, how would you know that this is going to be an all-time high here? Because QQQ didn't, so it's really difficult to pick and choose which sector you're going to trade. That's why I generally just trade the S&P 500 itself. Anyways, XLK did manage to make an all-time high, but I think this is a 52-week low, so this is difficult to trade. XLK has a little bit different composition than QQQ, and probably that's the reason why this happened. Nevertheless, Apple is also about 13% here, so we see a gap here. I believe this is earnings gap. And close below the 50, and then again a very bearish looking candle here. This is a shooting star candlestick. Also large distribution volumes here. So XLK, difficult to say because it went from 52-week low to 52-week high to all-time high. So I would say this is a tough call. Maybe I mean, I'm leaning bearish, but maybe this is somewhat bullish. All right, next is a XLF financials. I don't know. This is pretty clear to me. This is 52-week closing low. It did not make a higher high. The 50-day is below the 200-day, and now we're falling below the 200-day. So actually, this one is rather bearish looking too. Next one is XLY. Now this one is really interesting because here, just on Tuesday, we had this very nice looking white, almost completely filled Mariposa candlestick. And then next day, look at it, we immediately completely reversed it. Just immediately reversed it with a very similar looking candle on the downside. And then continue this week, and this is also one of my favorite bearish looking candles, is this very large filled body with a small shadow out of the top, and now we also broke the support here. So you know, this is quite bearish looking to me. You know, same thing here basically. It's Brett's momentum oscillator also moving into negative territory. Next, and the reason, one of the biggest reasons, of course, is why consumer discretionary are underperforming is because of retail ETF, XRT, or retail sector. Now, retail ETF XRT is very broadly diversified, and I think the Amazon is about 1 point some percent. So this is a broadly diversified retail ETF, and it's showing broad weakness. You can see a breakdown below this support, and then large gap, lots of you know, filled candles, and another very bearish looking candle this Friday. And look, we're already testing February levels here. So this is a February high, we're a February high. Now, it's possible that we hold here and maybe bounce a little bit, but I would not be looking to go long, especially after this kind of volumes. And of course, what is leading, you know, if we just, by the way, these four sectors, the XLK, XLF, and so the technology, the financials, the consumer discretionary, these three are almost 50% of the stock market, of the S&P 500. So these three really need to be performing, really need to be moving up. Instead, what we're seeing is where they're moving down. Okay, so which sectors are moving up? And that is defensive sectors. So XLU, utilities, all-time high pullback, and now approaching all-time highs again. You know, the way I look at it, utilities are still part of the stock market, and I can show you several charts from the historical examples where utilities did roll over together with the general market during a outright strong bear market, for example, 2008 and 2001. As of right now, they have not yet rolled over, but you know, honestly, if, you know, for my taste, I would rather just completely avoid stocks, and I'll show you where I would rather be later on in the example in the presentation. Another sector which is performing surprisingly well is retail, REITs. But again, you know, this is 52-week low, so the 52-week low is very bearish, and then we had basically a turnaround and made a 52-week high. It's difficult to play this kind of wild whipsaw in action. If you're able to catch it from down here, good for you, but this is due to you know, low interest rates. So again, the utilities and retail and rather REITs are also stocks, and I can show you numerous examples where they are extremely highly correlated to the general market. So if the market rolls over, Most likely, retail, or rather REITs and the utilities will follow the general market lower. If you're asking whether or not this my posture is limited to the United States, then this chart should pretty much answer that question. This is all world index, so it includes entire world. And it is also a close only chart on a weekly time frame. Unfortunately, there is no volume, but uh, this is a pretty clear downtrend that started probably here in beginning of last year, so about a year now, because this is an all-time high, and then we basically unraveled, made a lower low, lower high, lower low, and now we're possibly making a lower high. Now again, I'm saying possible because anything is possible in the stock market. We can just turn around and continue higher. But within the context of this ongoing downtrend, I would be, this is still a valid lower high, and I would be expecting lower lows. If we do turn around and break out above this high, then we could potentially say, okay, maybe we are attempting to turn this ship around, and maybe we'll actually end this bear market and begin a new bull market. Similar picture here. This is emerging markets. Topped out here in 2014, and then since then we're making a series of lower highs and lower lows, lower highs and lower lows, which is a definition of a downtrend and by extension a bear market. Again, it's possible we turn around and attempt to break out above this 36 level from last October. But as of right now, the trend is down, so it makes more sense for me to go short. Anyways, that's it with the stock recap. Let's continue on to the bonds now. Sorry. So during the bear markets, and I still think we're in a bear market in stocks, it makes more sense for the investors who are not willing to short to be in bonds. Bonds are close to or at all-time highs. This is TLT, 20 plus Treasury bond fund. We made the all-time high here, but you could see that this was almost a vertical ascent, especially this several candlesticks here in February of this year. So really this kind of ascent cannot continue. So a certain time to digest these gains really was needed. And that's what we've been having for the past few months. But I think that this is a very nice looking advance. In fact, my members are participating in this advance. We're pretty heavily in bonds right now. So, two things that you get from bonds: your portfolio is stabilized. There's not that much fluctuations. Plus, you get dividends. Plus, in this case, looks like bonds are gaining, so you get capital appreciation as well. In any case, this Friday looks like pretty clear flight to safety as stocks lost, bonds gained, and this was a nice, good-looking bullish candlestick. Also, notice this SCTR. This is Stock Charts Technical Rank, and this ranks various ETFs within the universe against one another. And you can see that it's back in, TLT bonds are back in the 90s. So this is again a top performing fund. And look at this performance here as well. So this is something to keep in mind is when bonds are performing this well, what does it tell you about the state of the stock market? On a longer term frame, this is weekly TLT. I showed this chart in the past. We had this. This is actually in 2015. Run up to then all-time highs, a big correction, an excellent buying opportunity if you are trading on the longer term charts. and then another all-time high just this February. And like I just showed, this was again a vertical ascent almost, so a correction was in order. And looks like we're getting this correction. And if I'm right, and this could be indeed a cup and handle, the depth of this pattern is 20%. And if we do break out above the lip of this candle and continue up 20%, this would be immensely bullish clearly for the bonds and very bearish for stocks. Okay, more diversified AGG, aggregate bond fund. This one is much more stronger than TLT, and the advance was here. This February advance also was a vertical like advance, but the correction was actually quite shallow. And then another breakout, several breakouts here, fresh all-time highs. Small pullback. Actually, I pointed out, if you watch some of my previous videos, I pointed out this little pullback, and it was very insignificant. And this, okay, yeah, this compared to TLT, this is nothing. And then lo and behold, we made an all-time high. This is an all-time closing high on Friday. So this is also quite a bullish chart. This is a longer term weekly time frame for AGG. This one is, again, looks stronger than TLT. The pattern is a little bit different. Maybe this is a rising, maybe this is a cup and handle also of some sort, but we already got a breakout here above the lip of this pattern. And this pattern is 3.4% deep, and we're about 2% up. So there's still a lot of room to run to the upside for the bonds. Volume looking good, and advance. You can see on balance volume is confirming this all-time high with an all-time high of its own. All right, let's switch gears a little bit and continue to currencies and commodities part of the presentation. This is US dollar on a daily time frame. Several weeks ago, I pointed out this big hammer candlestick, and I said this is a picture-perfect candlestick, textbook really looking like. Large shadow at the bottom, nice looking hollow body with a very small wick out of the top. Next day we got a follow through. This is indeed a confirmed hammer candlestick, and then we continued higher this past 2 weeks, and then finally on Friday we're almost touched the 50-day moving average. So this 50-day moving average, there are several, this area here at around 95, several things are happening there, and the reason why it stopped there is we had a bottom here in February, we had a breakdown below this bottom here, a rally back, and then we were not able to capture this area. Looks like we got resistance, all of this resistance area. So there's a lot of things that are happening around 95, and it does make sense for this rebound to stall around that area. Now, we did break this breakdown here in April, right there. You can see it more clearly right there. However, I am now wondering if this support break or was it a bear trap. And it's entirely possible that this was a bear trap, and now we may continue sideways and maybe break above this level here, about 95. Next chart I'll show that this actually could be quite bullish for the dollar index. Now, this is a longer term time frame. This is a weekly chart going back to 2013. We had a breakout here in 2014. Actually, very textbook looking like breakout, small pullback, and continuation. So this is a breakout, throwback, continuation. This was again almost a vertical ascent, so a pullback of some sort is in order. And since this is a weekly time frame, this is a long-term pullback. Maybe this entire thing is a cup and handle, and we are actually near the bottom of this range, and we held support for now in the 92 area, even though we pierced below it to 91. For now, I'm considering the support as being held, and we could go sideways and maybe continue higher from here. if we do continue higher, this will put pressure on commodities of all sorts, and we'll get to commodities in a few minutes. But this chart itself, you can see that if indeed this is a cup and handle, and we break out above 100, this is a 9% depth. So if we do break out, we could easily continue another 9% or higher after the breakout. For now, this support has held, but we'll see if it holds. There's going to probably be a retest of some sort, something like this again, maybe a throwback. Anyways, let's continue to gold. Okay, this chart has two graphs on it. One is green is the US dollar, yellow is gold. And if you know nothing about charts, you can kind of see that they are moving in opposite directions. When gold is gaining, the dollar is falling, and vice versa. When dollar is gaining, gold is falling. So and this, by the way, is a weekly chart going back to 1997. So I put a correlation coefficient here, and you can see that it more or less spends most of its time in the negative territory. And I would say that as far as relationships go in the stock market and trading universe, this is a very strongly negative correlation. Right now, that correction that I just showed you, so this is a 2014 breakout, and now we basically had a sideways consolidation. And we're at support here. The scale is 92.5. And of course, it does make sense since dollar was falling. This dollar is falling, gold is rising. So that's why we had this pretty strong rally in gold over the past few months. So here's gold, and this is a daily time frame. Gold itself. Multi-year lows here in December of last year, and actually we were trading gold on a downside with my subscribers here, so we had a nice gain here, and then we were able to break out above this level here, and then actually above this level as well. So at this point, we had continuation sideways, and then the 52-week highs just recently. Now, for the record, I think that gold is now bullish, but I think it will really depend on the dollar. So if the dollar continues to gain, gold will be under pressure, and you can see that gold has been under pressure for the past couple of weeks. It's been dropping the past couple of weeks, and dollar has been gaining for the past couple of weeks. They are literally inverse. And if you trade gold, it does make sense because gold is traded as is XAU over USD. So it's gold over United States dollar. This is a longer term chart of gold going back to 2011, and this is also a weekly chart. Here down below we have what's called a gold breadth index, also my proprietary experimental indicator, and it tries to call whether or not gold is in a bull or a bear market. And if I was to trade back then with this particular indicator, I would say that in 2012 we had a bearish signal around here. So this whole rally into 2012 into October, I would have been looking at only from the point of view of a shorting opportunity. We had several attempts at breakouts, and that's why I put breakout question mark. But you can see that none of them were confirmed by the by the gold breadth index. Only the latest one was indeed confirmed right here. So for now, I'm considering gold to be in a bull market, and I am looking for buying opportunities and to buy physical gold as well. However, you can see that we had quite large distribution volumes this past couple of weeks. Here, 3 weeks actually, and this was really high volume here as well. So some sort of a pullback is certainly in order. This is a very strong move for gold, so a pullback of some sort is certainly in order. Okay, this is GDX, Gold Miners ETF, and this is clearly even more volatile than gold itself. Gold is pretty volatile, but GDX is really up there. So this is an all-time high here, and this is a 52-week high. So all-time low rather, all-time low here in 2016, beginning of 2016, and then and the 52-week highs up here. Um, Very powerful move. This was a $12, and now we're over 100% move for GDX. And if you were able to catch it, good for you. Again, same thing here. This is a gold breadth index, but more zoomed in chart. You can see that it did enter the bullish phase here in March of this year, but honestly, this is a little bit too overbought for my taste. Again, this is almost a vertical advance here, so a pullback is in order of some sort. And I put on Fibonacci retracements here from the low here in January to the high here in end of April. So a 38% retracement. This is a shallow retracement. A 38% retracement would take GDX to about 2089. A more deep retracement will take it about 1926, and the deepest retracement, 61%, would take it to the breakout level, basically. And this is a breakout level up here at around $17. So I think anything below that, and we will start to entertain the fact that maybe this is again a false breakout, and maybe we're back into the bearish camp again. For now, since we do have market breadth indicators for gold miners, so far I see no concerns here. I see bullish indicators across the board, really. So this looks bullish to me, but I do need a pullback before I consider investing in this in this fund. One more thing I want to point out, up to here, about here, I was still thinking that maybe this rally was a bear market rally. But then I started getting improvement in my market breadth index, and I actually sent out an alert to my subscribers around here to avoid shorting gold and gold miners until the picture has clarified. And that's another thing is sometimes if you're not sure if the chart is ambiguous, sometimes it's just better to stay away from that chart completely, because up to this point I had no doubts that this is a bearish chart, but around here I started to have some doubts, and actually that's the reason why I sent out the alert. And then lo and behold, we did get a breakout and a new bull market. So that's another reason why you should consider signing up, is because sometimes if you don't know what the chart looks like, you can actually send me a question, by the way, Alex, what do you think this chart looks like? And I am quite available to answer those questions. Briefly, this is the United States Oil Fund. Not an ideal vehicle for investment. In fact, it's one of the worst vehicles to hold. If you're trying to hold and play oil, this is probably not a good idea if you're trying to hold it for a long time. Because this is an all-time low versus, of course, oil. It's not an all-time low. It's about whatever. It bottomed out here at in the upper 20s, I believe. But in any case, this is okay for trading, and it's highly liquid, so that's a good thing. This large volume indicates that we had a selling climax here in the beginning of the year. The price didn't immediately bottom out. In fact, it continued to bottom out for a few more weeks, and then eventually bottomed out, and now we're getting this rally. And this is a weekly chart, by the way. So maybe this is a rising wedge. clearly a bearish security. I don't think you can argue with a downtrend here. And rising wedges in a bearish security, you know what that means. It's a recipe for continuation lower once this rising wedge breaks. Up here around 12, we have resistance with this gap. So maybe we touch it, maybe intra week with a spike, and then maybe more volume will come in, and then sellers and short sellers will step in. I don't think this is a bullish chart at all. I think we will still yet to see more lows in oil and by extension USO, of course. Okay, the same thing. This is UNG, natural gas ETF. Again, this is completely not acceptable to hold long term, especially if you're trying to, gain from it. In my opinion, again, this is my opinion only, because these are all-time lows for UNG, and clearly UNG did not hit all-time lows. The natural gas rather itself did not hit all-time lows, but very similar picture. You can see very large volumes here that kind of look like selling climax. You can see that it really bottomed out, and now we have a sort of a rising wedge again. And then in the bearish security, rising wedges are bearish continuation patterns once the rising wedge is broken. You can see that these wedges can continue for a long time, or rising channels of some sort. So it hasn't yet been broken. I don't know when it will be broken, and on this chart it's kind of difficult to even draw resistance lines, but maybe there is resistance here at 8, possibly at here $8 50 cents, and definitely here at around 9 and change. So we will see where the selling come in, and you will be able to notice this selling by increased volume, by the way, also. So basically watch for large volume reversals near resistance levels. That's all I can say about this chart. All right, thanks for watching. If you liked the video, please do like it on Facebook, or on Facebook. Please do like it on YouTube. My name is Alex. If you have any questions, do send me an email. Please stay tuned to see how to find us on the internet. Thanks for watching, and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of risk control, as well as just a psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. You have Twitter, Facebook, YouTube, StockTwits accounts. You can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye-bye.